When you're ready to start investing in stocks, you first have to choose a broker. It's kind of like buying a car or a house. You can do all the research in the world and know exactly what you want, but you still need a venue or agent to conduct the actual transaction. Similarly, when you want to buy a stock, your task is to do all the research you can to select the company you want to invest in. Still, you need a broker to actually buy the stock, no matter who you choose to go with. The broker's primary role is to serve as the vehicle through which you either buy or sell stock. When I talk about brokers, I'm referring to companies such as Commonwealth Bank's CommSec, Stake, CMC Markets, or CoinSpot for crypto, and many other organizations that can buy stock on your behalf. Stockbrokers fall into two basic categories, which I discuss a bit more here: full service and discount. The type you choose really depends on the type of investor you are. Here's an overview of the differences. Full service brokers are suitable for investors who need some guidance and personal attention. Discount brokers are better for those investors who are sufficiently confident and knowledgeable about stock investing to manage with minimal help, usually through a broker's website. I don't really like the name discount because it sounds dodgy, but it just means you do it yourself. Although self-service brokers, with their seemingly limitless assistance, can make life easier for an investor, you need to remember some important points to avoid problems. Brokers and account reps are salespeople. No matter how well they treat you, they're still compensated based on their ability to produce revenue for the brokerage firm. They generate commissions and fees from you on behalf of the company. In other words, they're paid to sell you things. Remember, whenever your rep makes a suggestion or recommendation, be sure to ask why and request a complete answer that includes the reasoning behind the recommendation. A good advisor is able to clearly explain the reasoning behind every suggestion. If you don't fully understand and agree with the advice, don't take it. Working with a full-service broker costs more than working with a discount broker. Discount brokers are paid for simply buying and selling stocks for you. Full-service brokers do that and much more, like provide advice and guidance. Because of that, full-service brokers are more expensive. Handing over decision-making authority to your broker can be a possible negative because letting others make financial decisions for you is always a bit scary, especially when they're using your money. If they make a poor investment choice and lose your money, you may not have any recourse because you authorize them to act on your behalf. On the other hand, let's say that you know what you want and you can make your own investment decisions. All you need is a convenient way to transact your buy and sell orders. In that case, go with a discount broker. They don't offer advice or premium services, just the basics required to perform your stock transactions. Discount brokers, as the name implies, are cheaper to engage than full-service brokers. Because you're advising yourself or getting advice and information from a third party, such as Reddit, just kidding, you can save on costs that you'd incur if you used a full-service broker. Remember, if you choose to work with a discount broker, you must know as much as possible about your personal goals and needs. You need a greater responsibility for conducting adequate research to make good stock selections, and you must be prepared to accept the outcome, whatever that may be. Brokers issue their recommendations or advice as a general idea of how much regard they have for a particular stock. The following list presents the basic recommendations or ratings that they may use. Strong buy and buy. This means that the analyst loves the pick, and you'd be smart to get a bunch of the shares. The thing to keep in mind though is that buy recommendations are pretty common and definitely shouldn't be blindly followed because brokers sell stocks. Hold or neutral. When an analyst gives a stock a hold rating, they expect it to perform in line with the market and the same pace as similar stocks. This rating technically tells stockbrokers not to sell a stock or buy a stock. A hold rating is often assigned when there's uncertainty in a company regarding new products or services. It's direction or pending quarterly report card. If a company is not sure whether or not it's going to meet its guidance, even if it's still posting respectable profits, that could cause analysts to issue a hold rating. Sell. The sell rating is a recommendation to sell the specific stock. This rating means that analysts project the price of a stock will fall below its current level in a short to mid-term. It also implies that the analysts have identified major challenges that exist at the company. There are some other ratings that you will see, like here, outperform and underperform, that are slightly different, but I'm keeping it a bit basic here today. The bottom line with brokerage recommendations is that you shouldn't use them to buy or sell a stock. Instead, use them to confirm your own research. I know that if I buy a stock based on my own research and later discover the same stock being talked up on financial shows, that's just icing on the cake. The experts may be great to listen to and their recommendations can augment your own opinions, but they're no substitute for your own careful research. Your first share trade. Once you have decided which shares to buy or sell and you are set up with a broker, you're ready for your first trade. What does the market look like? When you are new to a share market, one of the hardest things to understand is what the market actually looks like. Here you can see an example of what you would typically see on a broker's website. This is the market depth for a share, which is the number of buy orders and sell orders that people have placed into the market. I'm showing you this live right now, but we'll change to referring to screenshots because it'll be easier to explain on a stagnant image with set prices. So let's have a look at an example now. Okay, so in the example shown here, we'll pretend you're looking at buying some shares. There are 3 basic points to consider: the price you're prepared to pay, how many shares are available to buy at that price, and the type of order. First, consider the price you're willing to pay. Using our example market here, if you want to buy shares, the cheapest price they are available for the market is $13.33. This is the price at the top of the ask or sellers column. Second, consider the number of shares you're looking to buy. In this example market, there are 141 shares being offered for the sale at the price of $13.33. The third consideration is the type of order you use. Broadly speaking, you can set a particular price that you're happy to trade at, a price limit order, or ask for your order to be placed at the top of the price queue and traded at the best available price, a market or market to limit order. Orders to buy and sell shares are typically matched first according to the best price and then according to the time at which they are entered into the system. This is known as price time priority. So let's say you want to buy 100 shares and you're happy with the price of $13.33 per share. You place a market to order. You can see from the market depth screen here that there is sufficient volume, so your order will trade. Your order enters the market and trades. Here you can see how the market adjusts to show that your order has been executed. You can see that your order of 100 shares has gone into the market and has traded with the other side. You can also see that your order for 100 shares has been executed and reduces to 41 available on the list of orders. Your order for 100 shares didn't fill all the shares on offer at that price, so there is still 1,416 left at the price of $13.33 on the ask side. Let's extend this example and consider a scenario where you want to buy 1,600 shares. Obviously, there isn't that many available at the price of $13.33, so you have 2 options. Place a market order, in which case you will need to accept a combination of prices at $13.33 and $13.34 to fill the volume of your order. Or you could place a limit order for the price you choose, let's say $13.29, and see if there are sellers in the market who will lower their price to meet your order and complete the trade. You can see that this is what multiple buyers are attempting on all times below the first row. It's important to note that the volume of buying and selling of shares in a company is known as liquidity. This is an important consideration because the more liquid the stock is, the easier it is to buy and sell quickly at the price you expect. We've already covered the liquidity a bit. Many companies have very attractive markets for their shares, with millions of dollars worth of shares trading every day. But there are also companies that have relatively little activity in their shares. The difference between the buy price and the sell price, or the bid-ask spread, may be quite a bit wider for an illiquid stock than for a liquid stock. If you want to buy a large quantity of shares of an illiquid stock, you may have to pay quite a bit more than the current sell price to get all of your order filled. Please make note that this example doesn't do justice to the dynamic nature of the share market. During trading hours, the price of the shares can be constantly moving, sometimes by large amounts. Buying and selling shares does require attention and diligence as the price of the share can move very rapidly. The examples I show above are how buying and selling works, but the likelihood of being fast enough to see such a minor change is quite low for most stocks. Again, specifically, liquid high turnover stocks. Using a limit order is one way to be sure of the price you expect to trade at. Next, I will go over limit and market orders more thoroughly. Limit order. A limit order enables you to be specific about the price you want to trade at. This means that for a buy order, the price you nominate is the maximum price the order will trade at. It can trade at less than this price, but not more. Using our example, you might place a limit order for $13.32. This is less than the current best price being offered for sale. The market might move to meet your price, in which case you have bought the shares at a cheaper price than if you had simply bought the shares at $13.33 each. A limit buy order at $13.32 can trade at $13.31, but will never trade at $13.33 or higher. For a sell order, the price you nominate is the maximum price the order will trade at. It can trade at more than this price, but not for less. For example, a limit sell order entered at $13.33 can trade at $13.34, but it will never trade at less than $13.33. Market or market to limit order. A market to limit order is commonly referred to as a market order. If you're happy to trade at the best prevailing price in the market, you can use this order. With this order type, you nominate the quantity you wish to buy or sell, but not the price. The principle of this order type is that you will trade at the best price available on the market. In the case of our example, you would buy the shares at $13.33, the best price at which they are being offered for sale at the moment. If the whole volume of your order can't be traded at this price, the remainder of the volume is then converted to a limit order at the price you traded.